Good morning, friends. Welcome for the today's class. And today is an important class as far as the business environment is concerned. Under Unit 3 of Business Environment, we are going to discuss an important policy of Government of India is monetary policy. If you go into the depth of the Indian economic system is made up of various policy. When India was in the crisis in the year 1990, P.V. Narasimha Rao has made an LPG policy where the India was in a crisis of foreign reserves. To come out of that foreign reserves, he made certain changes in the two important policies which are known as fiscal policy, which is also known as a budgetary policy, and second most important policy is monetary policy. Now friends, today we are going to discuss what is a monetary policy and how this monetary policy helps in understanding the business environment and how the companies will analyze this environment to make the good decisions for their growth of the organization. Now friends, coming to the introduction of the monetary policy is an instrument. It is used an instrument which is used to control or regulate the interest rates of the central bank, money supply and availability of the credit to view in achieving the ultimate objective of the policy. Monetary policy also a policy of central bank which regard the use of monetary instruments in achieving the goals. So as per the RBI Act 1934, the monetary policy is controlled by Reserve Bank of India. But before we start understanding the monetary policy, it is important to know what are the money aggregates. So how important these money aggregates are in understanding the monetary policy. Now friends, coming to the money aggregates, we start with reserve money, and reserve money is also known as MO. It is known as high powered money, money base and base money, etc. So MO can be understood like circulation of currency plus bankers deposit with RBI plus other deposits with RBI, and this is known as a reserve money or MO, and it is the monetary base of the economy. And there are some more concepts under the money aggregates, that is M1. M1 is also known as narrow money. M1 is a currency with the public and demand deposits with the banks and other deposits with the RBI. M2 is equal to M1 plus all the savings deposited at post office are considered, and when we combine M1 and the other savings of post office, then we can call it as M2. Now coming to M3. M3 is also known as broad money. Now M3 is equal to M1 plus time deposit with the banking system, and M4 is equal to M3 plus all deposits with the post office saving banks. So friends, here what the two important concepts we have studied under money aggregate is, one is the narrow money, that is M1, and broad money. Now moving to the next slide, objectives. What are the objectives we need to understand of the monetary policy? So friends, whenever you study any concepts, it is important to understand what are its objectives. Now the primary objective of the monetary policy is rapid economic growth, price stability, exchange rate stability, balance of payment equilibrium, full employment and equal income distribution. So these are all the important objectives of monetary policy. But friends, the main objective is price stability and controlling the inflation, and how it is going to be controlled we are going to discuss in the coming classes. Right, now coming to the important topic, that is instruments. So in the previous slide we have been discussing that monetary policy will control the inflation and deflation of the country. Now what are the tools available What are the tools available by the RBI to control the monetary, the money supply or inflation and deflation in the country? So we classify these instruments into qualitative instruments and quantitative instrument. Now coming to the qualitative and quantitative instruments are bank rates, open market operations, cash reserve ratio, statutory liquidity ratio, repo and reverse repo ratio. These are all known as the quantitative tools. Now friends, before we start the qualitative tools, for today's session, we are going to start with the quantitative tools. Now under quantitative tools, the first and foremost important topic which we are going to discuss was cash reserve ratio. Now cash reserve ratio is also considered as a direct instrument. Now why it is a direct instrument, we are going to discuss right now. So cash reserve ratio means the amount of funds that banks has to maintain with the Reserve Bank India at all the times. So friends, listen carefully, because this CRR, cash reserve ratio, is also known as a direct instrument. Now what is a direct instrument? Cash reserve ratio means the amount of funds. As per the RBI Act 1934, every commercial bank has to maintain a portion of its cash reserves with RBI, and that amount is known as cash reserve ratio. Now currently the cash reserve ratio is 4%. For example, to make it very clear, I'll take one example. Take example a bank. An X bank has 100 rupees of their amount in their bank. So out of 100 rupees, if 4 rupees of the amount need to be kept with the RBI. That is the portion of the time deposit and net demand and time deposits has to keep it with the Reserve Bank of India. And this keeping aside the cash reserve is known as cash reserve ratio. And friends, to make it clear, this cash reserve ratio is done on daily basis. Every day, all the commercial banks in India has to maintain this CRR, cash reserve ratio, in with RBI. And the central bank has a right to decide the percentage change in the RBI to change the interest rate, how they are going to charge. And one important point, friends, RBI will not give any interest on the cash reserve ratio to any commercial banks. Now, I hope you understand this concept very well. Now, after that, one more direct instrument I want to discuss was statutory liquidity ratio. We can also call it as SLR. Now, what is SLR? SLR means statutory liquidity ratio is a minimum percentage of deposits that a commercial bank has to maintain in the form of liquid cash, gold or other government security. So friends, keep it in mind. Every commercial bank, certain percentage of the deposits has to maintain within the bank, in the form of, can be a liquid cash, it can be in the form of gold, or it can be in the form of other security. And current SLR rate as per RBI is 18%. Now, it is clear, friends. Do you understand what is cash reserve ratio and what is statutory liquidity ratio? These two tools or instruments are considered as the direct instruments. So, friends, whenever the RBI wants to control the inflation or deflation of the country, so they take the decisions either to increase or decrease CRR or SLR. So these are the two important concepts under the monetary instruments, which is considered as the direct instruments. Now friends, we will move to the indirect instruments, repo rate and reverse repo rate. Now what is repo rate? Now repo rate means repurchase option or repurchase rate. As you all know that every commercial bank will take or borrow the money from the RBI. So as we all know that when there is a insufficient funds of any commercial bank in the country, it's their responsibility to borrow it from the RBI. Now what is repo rate means? Repo rate is the interest rate at which the RBI borrows funds, RBI grant funds to all commercial banks for a short term period. So friends, please keep it in mind. Repo rate is the interest rate where RBI grant funds to all the commercial banks for short term against government securities, and particularly this is for a short term, and it is also known as short term funds, and short term means 90 days. So a repo rate is a short term tool used by the banks to fulfill their financial requirements for 90 days. So a RBI will lend the money to all the commercial banks up to 90 days. This is known as a repo rate. Now this repo rate, they charge at 5.50. The current RBI rate is 5.50. Now before we'll go to the reverse repo rate, I want to start with the bank rate. Now what is bank rate? So to be frank friends, bank rate is not a tool. Bank rate is, in most of the textbooks and most of the books they have written that bank rate is a rate at which all commercial banks will take loan from RBI, but it is not true. Now what is a bank rate means? A repo rate, the repo rate at which the commercial banks are taking the loan for 90 days. If any commercial bank not able to pay on time or within the 90 days, directly it will be converted into a bank rate. So friends, listen carefully. What is a bank rate? No RBI will borrow money from any commercial bank because RBI is a central bank. RBI will not borrow any money from any commercial bank. Now what is the reality is, the banks which they are taking the loan under repo rate, after 90 days, if they are not able to pay, then it will be converted into a penalty rate, that is a bank rate. So friends, be clear, and this is one type of a penalty rate by the RBI of India. All the loans which are taken from RBI not able to pay on time, that is within 90 days, all those are considered as a bank rate. And now always a repo rate is less than bank rate, because bank rate we are calling it as a penalty rate. Now currently 5.75 is the bank rate which is charged by for commercial banks, RBI charging. So friends, be clear, bank rate is no such rate, but whatever the amount which is the loan taken by the commercial banks in the repo rate, after 90 days, if they are unable to repay it, it is converted into a bank rate. This is known as the bank rate. Now next friends, we'll move to the repo rate. Now what is repo rate? So repo rate, in most of the books it says that reverse repo rate. Reverse repo rate means RBI will borrow money from the commercial banks. So friends, in reality it is not correct. What means, whatever the amount, excess amount left with the banks, what is the excess amount left with the commercial banks, they kept idle because they can't push that money into the market, because market is facing an inflation situation. So a market cannot take the loan from the banks. So banks has excess money with them. Now what they can do, that excess amount of the money, they are keeping idle. Now instead of keeping that amount idle, RBI asks all the commercial banks, why can't you give that amount to me? I'll pay interest. Isn't not a good idea? Because friends, RBI is always a well-wisher to the commercial banks. So RBI says that whatever the excess amount you have with you, so please give to us, we'll provide the interest rate. By that, your money will not be wasted, and whenever there is a requirement, we are ready to provide that. And this concept is known as reverse repo rate. So thank you, friends. Today I am closing the session for today. In tomorrow's class or the next class, we are going to discuss few more indirect instruments. Thank you so much.